There are two types of general liability policies: an occurrence made or a claims made format. And the reason that is important to distinguish for you is it differentiates when a claim can be a claim. An occurrence made policy is the most common type of liability policy. I'm sure there are statistics out there. I would venture to say 70 to 80% of policies for general liability will be occurrence made. It is the more usual format in America for America and for companies doing business with American companies. Usually the expectation is going to be occurrence made. And it means that if the incident happens during a policy period, no matter when the claim is reported, it will be within that policy period. Claims made must be reported during the policy period or within the retroactive period to be considered an appropriate claim. There are certain industries, and we're not going to get into a whole list of what all those are, but there are certain industries or certain types of policies which are more common to be on a claims made format. For example, if any of you listening are outside counsel at a law firm, your E&O, also known as professional liability, is likely on a claims made format because that type of policy is more commonly to be seen on a claims made. This is honestly a concept that can be a little hard to really fully understand, even for insurance professionals, to be honest. On the screen, you will see a little slide that shows an example of an occurrence. You can see when the policy period started, when it ended, generally a 12-month term. So that's what's shown there. When the loss occurs, and that the loss is reported after the policy period. However, the loss is still going to accrue to the policy period for which the loss occurred. So that's why it's called occurrence. It follows whenever it occurred. And then if we refer to the next example of a claims made, you'll see the addition of retroactive date, which will be part of the policy period itself, and then an extended reporting period. We have a loss that occurred before the policy period, but within the retroactive date, and that will be counted within the policy period of when it was reported, not when it occurred. So that's the main difference. And it's important to know if your company has the coverages on an occurrence form or on a claims made form, because you may have to modify the requirements to make sure that you are in line with your contract. If your company's template requires that the general liability be on an occurrence format, and the counterparty wants to change to a claims made because that's simply what they have, usually my practice has been to accept that, and then you will add some language that denotes the reporting period to make sure that there's no gaps in potential claims and the coverage available. But that should not be a holdup to moving forward with a contract